What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this afternoon. So what we're going to be covering in this update is a little bit of the price action and the technical analysis that we have seen on AMC, specifically on yesterday's trading day, Friday, the 29th of April. In addition to this, we also have to take a little bit of a look at the Ortex data that we're seeing on both AMC and GME. We are going to take a look at the max pain data going into next week. But with the overall volatility of the market right now and things really not looking too good in terms of basically the entire kind of U.S. economy heading towards a recession, we had negative 1.4% decline in GDP. If we have another quarter of declining GDP, that is going to signal a recession. We have the Fed coming in looking to raise interest rates. We have inflation running really hot. We have the Russia-Ukraine conflict going on right now. There are a lot of things that are pointing to significant downturn or volatility coming in the market. And the DTCC has just issued their newest wave of collateral haircuts. I want to give you guys a really in-depth understanding and breakdown of what this means, because this is going to be really important going over the next couple of weeks and is going to lead to a significant amount of margin calls. Now, when you guys think about margin calls, you have to think about them in a couple of different ways. One, it is very, very rare to see a news article coming out that, oh, this institution got margin called because of this, this, and this. That rarely happens. The only time that I've really seen this over the last basically 2 years was the UBS situation where they were downgrading the value of those Russian bonds, and they said that could lead to lots of margin calls. But with the overall kind of trend of the market recently, these calls have been going out left and right. And thinking about kind of the situation with Archegos and Bill Huang, where Bill Huang basically just didn't answer the phone to essentially hear what Credit Suisse and a lot of these other banking institutions had to say to avoid the margin calls. This is very different. This is changing the overall rules of the game on the people who are playing it. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. And again, the markets are really crazy right now. If you guys do want to kind of take advantage of this opportunity and the volatility in the market to learn how to make money in this kind of marketplace, make sure you check out that link down below to the Discord. We alert you guys on the 1348 crossovers on over 850 stocks, over 40 private live streams every single month, one-on-one training sessions, and the exclusive proprietary trading algorithm that we have developed as well. So AMC closed the day on Friday at $15.30, down about 2.17% here. But the overall market, the S&P 500, was down about 3.7%. Typically, in the past, when we have seen giant red days in the overall market, AMC has had double-digit percentage red days. That is not what we saw on Friday. Now, it's not fun to see AMC down 2% on a day, and especially the day before when the market was really rallying, AMC didn't really come with it. What we're kind of waiting to see here, honestly, is a picking the direction of the trend of the overall market. You guys have seen the videos that I've made about kind of the timing of the last kind of run up in the SPY from the 14th to the 29th of March, and it lines up perfectly with the run on AMC. So if we start to see the market pick an overall direction to the upside or the downside, we're going to see AMC start to move with it. Now, taking a look at this on the 4-hour time frame really quickly here, again, we are still waiting for that 1348 cross to the upside. We are just kind of hovering this 13 on the way down. We need to see some clean breaks to the upside, these crosses, these closing candles above the 200 EMA, very similar to what we saw back here, to really send us going back to the upside. So let's do a little bit of a quick breakdown of what we have going on with the Ortex data before we get into this situation with these big margin calls, these collateral haircuts, and what all of this means and how it's going to affect you. So we have 18.96% estimated short interest on AMC here. We have 1.91% average cost to borrow, 2.73% max. We also saw about 988,000 shares borrowed on Friday in terms of the net amount of shares that was borrowed. Now, GameStop over here, 20.09% estimated short interest, 12.66% or 12.66 million shares estimated to be sold short, 6.72% average cost to borrow, 9.87% max. Then going over to the max pain data really quickly before we start talking about a lot of the important stuff, $17.50 going into next week. But again, max pain, we haven't really seen us finish around max pain over the last couple of weeks. So this is not going to be the end-all be-all of where we are going to trade on any given week. But it is helpful to kind of look and see where the options are placed in terms of where those key levels are for delta hedging of market makers. So let's get into this DTCC situation. What they're talking about here is a collateral haircut. Now, what is a collateral haircut? The important thing here in finance, a collateral haircut, is the difference between the current market value of the asset and the value ascribed to that asset for the purposes of calculating regulatory capital or loan collateral. The amount of the haircut reflects the perceived risk of the asset falling in value in an immediate cash sale or liquidation. That is a very, very, very important piece. So when we are going to be looking at all of these haircuts right now and what they mean, any sort of percentage is what the haircut is. So if it's a 2% haircut and you have a security that's worth $100, you can only use $98 of whatever that security is to post as collateral. In addition to this, we're also going to talk about some of the things that kind of give these different securities risk. Now, a lot of these securities that are getting these haircuts don't necessarily seem all that risky in a normal marketplace. So when we come over here, this is the notice that was sent out. So beginning May 2nd, 2022, for the settlement date May 3rd, 2021, the DTC will update the list of current lenders to the joint DTC and NSCC, National Securities Clearing Corporation, committed 364-day line of credit facility with a consortium of banks. Now, we see this list down here. You're going to see JP Morgan, Bank of America, and a lot of these are other large institutions that we all know and hate. Now, when we come down a little bit further, here's where we start to get into some of these haircuts here. So this first section is going to be U.S. Treasuries. Now, U.S. Treasuries are typically going to be that risk-free asset, or it's supposed to be the risk-free rate or the risk-free asset that we're seeing here. So compared to some of the other securities that we're going to look at here, these aren't going to be as risky in terms of the risk that the lenders are taking on, the purchasers of these securities. So when we're looking at the haircuts here, interest-bearing U.S. Treasury securities with remaining terms to maturity of up to 2 years, meaning there's about 2 years left until this bond matures, a 2% haircut, 3% haircut, 4% haircut, 6% haircut. That's not too bad. Zero coupon bonds, 2%, 5%, and then this 12% with remaining terms to maturity in excess of 5 years. Now, here's where it gets a little bit interesting. Mortgage-backed securities issued by a U.S. agency and U.S. government-sponsored enterprise, GSE. Interesting. So now these MBS, these mortgage-backed securities issued by a U.S. agency and U.S. government-sponsored enterprise, GSE, rated below AA2 or AA are receiving a 100% haircut, meaning that these can no longer be posted as collateral. You cannot basically buy these mortgage-backed securities and then use them to lever up. Now, we've seen kind of the developments in the real estate market recently. We've seen mortgage rates really start to skyrocket after the Fed has started raising interest rates. We've also started to see some of the foreclosure numbers start to pop back up. They're not at any crazy levels yet. If you look at the chart, it's kind of inflecting and coming back up. Those the levels of foreclosure, in my opinion, are not really a cause for concern yet. But if you continue to see that trend really start to skyrocket with these foreclosure rates, then it's really going to be an issue. And when we think about these ratings right here from these ratings agencies, remember, those ratings agencies were one of the institutions that were really at fault back in 2008 in the time period around there for kind of misrating a lot of these securities, kind of saying that they were less risky than they actually were. So when we take a look here at basically what AA2 is, this is Moody's. So AA2 is the third highest long-term credit rating that the ratings agency Moody's assigns to fixed income securities like bonds that are of high quality and very low credit risk. So if it's still pretty high quality and very low credit risk, Why is it getting a 100% haircut? Is there some sort of really large systemic risk out there in the market right now with these MBSs? Most likely. Now, there's a couple of other really important things that I want to kind of go over with you guys in this as well. Scrolling down a little bit further, let's see where we get down here. I think it's towards the bottom. I want to make sure that we get to the right one right here. U.S. equity securities. So equity securities listed on a U.S. national securities exchange. So these are going to be things like Apple, Tesla, Google, these types of companies. Now, it breaks it down in terms of with a market price of $5 or more per share or per other unit, or with a market price below $5 a share or per other unit. Anything above $5 a share is getting a 50% haircut. So you would need to buy, let's just say we're using Apple, for example. If you wanted to post $100 of, or you had $100 worth of Apple, let's just say in this example, and you wanted to use that as collateral, you can only use 50 of it. So if you already were at a position where, let's just say you were using a higher percentage of that Apple stock to post as collateral, and you can now only use 50%, that is definitely going to lead to margin calls because, one, you're no longer going to be meeting those maintenance margin requirements because remember I said earlier in this video, they are changing the rules. They're not necessarily going out and saying, hey, we're going to change the maintenance margin percentages on all of your different accounts. It's changing the types of collateral that they can actually post and the percentage of the value of that collateral that they can actually use to lever up on these positions. And any stock with a price below $5 a share is getting a 100% haircut, which does make a lot of sense. Now, the last thing that I kind of want to touch on here, before we kind of wrap up this video is, yeah, we're talking a little bit about margin calls. We're talking about these collateral haircuts, but what has margin debt done over the last couple of quarters and months? Now, we've taken a look at this chart a few times, the FINRA margin debt and the S&P 500 real values adjusted to present day dollars. Remember, this chart's inverted right here. So on the left side, you're going to see as you kind of go down this chart here vertically, it's also in billions. So when you see these numbers go down, they're actually going up. So when you see this giant spike here in this red line, that's margin debt. That means that margin debt is going down. You can also see it kind of lines up with the S&P too. The S&P starts to come down as margin debt decreases. And this is a trend that we start to see a lot throughout history. Now, what this is basically telling us is that there's a really, really large wave of deleveraging coming. Now, could this be the result of margin calls? Yeah, it absolutely could be. And could this pick up with these collateral haircuts? Yes, it absolutely can. But this also could be the result of people flying out of the market right now because there's just so much risk and there's so little opportunity to get yield in this marketplace. So that is going to wrap up this update on AMC. If you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great weekend, and I'll see you guys in the next video.